Welcome. Today we are breaking down the Indian money market. Think of it as the financial engine room where banks and the government manage their daily cash flow. Unlike the stock market, this is strictly for short-term funds, ranging from just one night to 1 year. It's the primary tool the RBI uses to control inflation and liquidity. When the RBI moves, the money market reacts first. How fast do banks need money? If they need it for just 24 hours, it's called call money. If they need it for 2 to 14 days, it's notice money. Anything longer, up to a year, is term money. Interestingly, these deals are uncollateralized, meaning they are based on trust and creditworthiness. They happen on the NDS call platform, and the money moves instantly via RTGS. When the government of India needs a short-term loan, they issue T-bills. These are considered the safest investment in the country. You don't earn interest in the traditional way. Instead, you buy them at a discount, say, paying ₹98 for a ₹100 bill, and the government pays you back the full ₹100 at the end. That ₹2 difference is your guaranteed profit. Now, let's look at the private sector. Commercial paper, CP, is an unsecured note used by big companies to raise quick cash. Because there's no collateral, only companies with a high A3 credit rating or better can issue them. On the other side, we have certificates of deposit, CDs. These are issued by banks when they need to boost their reserves, and they require a minimum investment of ₹5 lakh. Finally, we have repos, the backbone of market liquidity. In a repo, you sell a security today and agree to buy it back later at a fixed price. To make this safer and easier, the RBI introduced tri-party repos. Here, a third party, like CCIL, steps in to manage the collateral in settlement. This allows more players to participate without worrying about the technicalities of managing the bonds themselves. To wrap up, let's talk about the RBI's special weapons, LTRO and TLTRO. During the COVID-19 pandemic, the RBI didn't just want short-term fixes. They launched targeted long-term repo operations to pump money specifically into struggling sectors like NBFCs. This ensured that even during a global crisis, the wheels of the Indian economy kept turning with affordable credit. Now, let's put two of the most popular money market instruments head-to-head, commercial paper, CP, and certificates of deposit, CD. While they might look similar, they serve very different purposes. Who is the issuer? First, look at who is asking for the money. CPs are issued by highly rated corporates and NBFCs to diversify their short-term borrowing. On the flip side, CDs are issued by scheduled commercial banks and financial institutions when they need to raise short-term resources. Security or nature. In terms of security, commercial paper is an unsecured promissory note, which is why the RBI requires a minimum credit rating of A3 to protect investors. CDs, however, are negotiable instruments held in dematerialized form, essentially acting like a high-value, tradable fixed deposit for the bank. Investment size or limits. If you're looking at the numbers, CDs have a clear entry barrier, a minimum investment of ₹5 lakh. Both instruments share a similar maturity timeline, ranging from 7 days to 1 year, but banks typically issue CDs for 3, 6, or 12-month periods. Getting your money back. What if you want to exit early? There's a big difference in buyback rules. You can't ask a company to buy back their CP until 30 days have passed. But for ACD, the buyback can happen much faster, just 7 days after the issue date.